Good day, everyone. We are Group 7 reporting on Nortel Network's Audit Committee was in the dark, a case on fraudulent and questionable financial reporting, governance, accountability, and management.
So here's the platform for our case. First will be the background of the case. Second will be the concept discussed. Third will be the answers to the questions in the case. The fourth will be discussed is personalities mentioned, and the last, current status of the company. Can you next the page, please? So let's discuss first for the background of the case. The Nortel Networks Corporation is a telecommunication of data networking company. It is founded in Mortel, Quebec in 1985, and its headquarters is located in Ontario, Canada. Became one of the giants of telecommunication industry, manufactured 73,000 employees around the world, and by the year of 2000, the company had issued over 3.8 billion shares worth of $473.1 billion in market capitalization. Can you next, please, the page? Now let's discuss the events in chronological order. When Frank Dunn became CEO in 2001, supervision practices he and other finance employees adopted were not in compliance with US GAAP, particularly the Statement of Financial Accounting Standards number 5. In the third quarter of 2002, the analysis showed approximately $303 million in provisions were no longer required and were available for release. The CFO and the controller and each corporate officer knew there were excess provisions, did not advise the audit committee or the board of the directors.
In the fourth quarter of 2002, at the management's recommendation, the board determined to reward employees with bonuses on their bonus plans tied to profitability. The plans included the return to profitability, or called RTP, bonuses, and another plan was called the Restricted Stock Unit, or the RSU plan. In this year, the loss reported no employee bonuses were paid for that quarter, and a record of 175 million additional provisions were identified. In the first quarter of 2003, Don told employees that he intended to achieve profitability one quarter earlier, and so he established an internal EBT target for each business unit and for corporate to reach that goal. So in excess provisions totaling 361 million enabled Nortel to show a consolidated pro forma profit in the first quarter, notwithstanding that its operation were running at a loss. Second quarter of 2003, a senior corporate management developed an internal EBT targets to achieve pro forma profitability. The audit committee approved the quarterly results, and the board approved payment of the second tranche of the RTP bonus and the awarded restricted stock under the RSU plan. The CEO, the CFO, and controller failed to advise the audit committee or the board of directors that the business units were running at a loss. So in the third and fourth quarter of 2003, the audit committee expanded its investigation to determine whether the excess provisions were released to meet the internal EBT targets in any of those two quarters, but no evidence emerged.
Okay, so the concepts that will be discussed in the chapter that is related to the case is accountability, corporations' behavior, agency theory, and ethics. So first off, accountability. Next, please. To define accountability, it is the fact or condition of being accountable or responsible. Members of the corporation or the company each have their own roles and duties to perform in order for the company to achieve its goals. Directors operate under state laws that impose fiduciary duties on them to act in good faith, with reasonable care, and in the best interest of the corporation and its shareholders. In a stakeholder accountability oriented governance process, the board of directors must take all stakeholder interests into account and make sure that they are built into the company's vision, mission, strategy, policies, codes, practices, and more. Failure to do so may cause to lose the support of these stakeholders. An element of the SAOG system is that there must be an ethics officer to watch over the ethical culture and serves as the person whistleblowers report to anonymously. Shareholders usually elect the external auditors to provide expert opinion on whether the financial statements prepared by management present fair results and in accordance with the GAAP. These external auditors are required to meet with the audit committee to discuss financial statements, their work opinions, and the state of the company's internal control measures. Also, while internal auditors assess whether the company's policies are comprehensive and are being observed. Lastly, professional accountants employed by the company must also do their duty to serve the public interest and report any financial wrongdoings to the CFO, and if appropriate, actions are not taken, to the EO, CEO, and to the auditors. Next, please. Next na rin po.
So for the second concept, namely corporations' behavior, people make things happen, so it is essential that their motivations are aligned with stakeholder expectations, which can only be accomplished by ensuring that the values underlying corporate motivational elements are similarly aligned. This alignment is vital for directors if they are considering merit or performance, rewards, stock option bonus systems, penalties for malfeasance, etc. Next slide. In the face of competing value systems for the motivation of personnel, corporations should consider which set of values most aligns with those of their shareholders and of their most important stakeholders. These universal values are honesty, fairness, compassion, integrity, predictability, and responsibility. Next, please.
So the last but not the least is the agency theory and ethics. Shareholders expect and hope managers will behave in line with the goals set for the corporation. As such, incentive systems and punishment systems, which include ethical dimensions, are created to try and influence the agents to stay on the right path and avoid conflicts of interest. Next. And now we will be discussing our answers to the questions related to the case. Next. So first off, why would Nortel Networks, a Canadian company, hire a US law firm to undertake an independent review of factors that led to the restatement of accounting reports? So a law firm based in the United States was most likely chosen because they already have a great understanding of and expertise with the Securities and Exchange Commission in the United States. This would also assist the corporation in obtaining support during a stock valuation. Other point to consider is that any conclusions will not be made public and will be kept confidential and protected by the attorney-client privilege, which is under the rule that attorneys may not divulge their clients' secrets, nor may others force them to. The purpose of this privilege is to encourage clients to openly share information with their lawyers and to let lawyers provide effective representation. And any additional conclusions would also be
inadmissible in a lawsuit against the directors. A law firm might also hire other experts, and the result of other experts would be protected as well. Next. Question number 2. Why did the independent review focus on the establishment and release of contractual liability and other provisions, also called accruals, reserves, or accrued liabilities? The independent review focused on verifying the company's liability since the audit committee seemed interested in learning more about the actions or the events that led to the significant excess liabilities being kept on the balance sheet and were not written down when it is already appropriated. These contractual liabilities were a result of previous years' provisioning process, which is based on the judgments that are made by the company's obligations. Next, please. Question number 3. How did the failure to follow US GAAP permit the manipulation of earnings before taxes that led to fraudulent behavior? According to the generally accepted accounting principles, accrued liabilities result from the recognition of expenses for which payment of cash or other assets will be paid in a future period. Sometimes the amount of a future payable is uncertain due to future conditions and or external factors, and the amount of the liability must be calculated using the best information available at the time. In such circumstances, a provision is made for the expected amount, resulting in charging an expense against profit. In this case, the company makes an estimation of the total expenses, which is the accrual, and reduces the accrual once the bills are paid. If the actual charges are less than the accrual, the excess accrual is recognized as profit, and that is one of the reasons why the Nortel company was able to manipulate the earnings before tax. Next, please. Contingent losses are one type of these estimated liabilities. A contingent loss is a possible loss or expense derived from past events which will be resolved as to existence and amount by some future event confirming or rejecting the loss. Nortel overstated contingent contractual agreements or debt on the liability side and losses, which is credit expenses, in 2002, and subsequently released or reversed these accruals or estimates, increasing revenue and decreasing liabilities. Next, please.
Okay, so question number 4. Describe the Nortel return to profitability and the restricted stock units bonus plans. What did the board of directors expect these plans to achieve? So by mid-2002, the morale at Nortel was low, and this led to the decrease in the number of employees as they were being recruited by other companies. So in order to somehow motivate and convince the remaining employees to stay, Nortel's board of directors determined to reward employees with bonus plans, which would stop losses and instead generate profits. So RTP, or return to profit, it is a one-time bonus payment which is given to every employee except 43 top executives. In the first quarter, the company achieved pro forma profitability. The 43 executives were eligible to receive 20% of their share of the RTP bonus in the first quarter in which the company attained profitability. 40% after the second consecutive quarter of cumulative profitability, and the remaining 40% upon the fourth quarter of cumulative profitability. For RTP bonuses to be paid, pro forma profits had to exceed the total cost of the bonus for that quarter by at least $1. RSU, on the other hand, or restricted stock unit, made a significant number of share units available for award by the board of directors to the same 43 executives in 4 installments, which is tied to profitability milestones. And once a milestone was met, the board had discretion whether to make the award or not. Next, please. So, question number 5. Were the misstatements of EBT and bonuses paid material in an accounting sense? So in the first place, in accounting principles, we have what we call materiality, wherein it refers to the impact of omissions or misstatements of information in the financial statements. In Nortel's case, the board of directors is focused on turning their losses into profit through the bonus plans. The management also adopted an approach wherein costs were masked and would only choose to disclose its pro forma earnings when the company expected losses. By using this approach, it made it seem like the company was beating its benchmarks while appearing to be stable, and their competitors are showing poor performance. Even if the company experienced significant losses, profitability had still been attained from an operational standpoint. With this, it can be said that these misstatements or restatements of EBT and bonuses are in fact material. Next, please.
Okay, so why didn't Nortel's auditor discover the misstatements? It is possible that the auditors did not properly review and verify past records, resulting in them only asking the management for justification to validate the liabilities reversal after it had been disclosed, resulting in a number of restatements from previous year's financial statements. They most likely did not review the end of the period adjustments because they were either ignorant or thought they were insignificant. The guidance needed on the audit procedures regarding the validation of the accounting estimates, materiality, and restatements was unclear and poorly dispersed throughout the different sections of the auditing standards. The auditors weren't able to ensure if their clients were using appropriate models and considering reasonably accurate estimations or assumptions. Since Nortel's finance executives stretched the judgment inherent in the provisioning process to create a tool to achieve their EBT targets, the accounting estimates frequently required management to develop models and assumptions regarding possible outcomes, including timing, transactions, or events that was uncertain and at the time of estimation. Question number 7, why didn't the audit committee or board as a whole anticipate the manipulation? Nortel's audit committee to review and report the end of the period statements, including the accrual reversals which caused the pro forma based bonus plans. The auditors failed to review other discretionary adjustments before approving the financials and bonus payments the company had dispersed. They overlooked these responsibilities, which made them not anticipate the manipulations made. While the board of directors as a whole failed to develop an adequate control environment in the company as well as appropriately evaluating the financial reporting risk, they also failed to conduct proper monitoring of management estimates or assumptions. Lastly, the board of directors appeared to pay little attention to the back office functions such as accounting, internal audit, and human resources. And as a result, earnings manipulation occurred without their notice. Okay. Question number 8. What question should the audit committee or board have asked? The audit committee should have inquired the components of the income statements as well as the accrual reversals that triggered the pro forma based bonus plans. They should have also addressed the fact that the company should not only meet earnings targets, but also develop plans for rebuilding shareholder value, as well as the role of the reversals that occurred and how they were determined in the first place.
Question number 9. What internal control flows permitted the fraudulent manipulation to occur without detection? Control environment, risk assessment, control activities, information and communication, and monitoring are some of the potential flaws which will not be clarified until expert witness testify. Next, please. Question number 10. How would the new requirements spawned by the Sarbanes-Oxley of 2002 and its tech regulation have prevented in the manipulation per se? Why or why not? The Sarbanes-Oxley Act of 2002 has a new requirement for corporate auditing practices that held broad provisions such as maintaining auditor independence, improving corporate responsibilities, and enhancing financial disclosure. It spawns more specific requirements that might have prevented the manipulation, so its tech regulation did not prevent this manipulation due to the risk of management overriding in a weak control environment and the fact that internal controls cannot be prevent all fraud. They can only reduce the possibility of the fraud happening. Next, please. Question number 11. How have the expectation of the audit committee changed since SOX with regard to corporate culture? Why is this so? And how can the audit committee ensure that these are met? As SOX reaffirmed that the primacy of the board directors are classified roles and the set of expectations for their performance in the framework of understanding and the importance of the corporate culture, the audit committee expectation has changed to a new standing of the importance of corporate culture as part of an internal control essential to the preparation of reliable and accurate financial reports. As a result, the audit committee will be in charge both internal and external auditors, serving as a functional head of the internal audit department while also taking a lead in reviewing and appointing external auditors who actively question management on financial reporting integrity issues. External auditors must now report to the audit committee on discussion with management, opinions expressed, and where those opinions were not followed.
Okay, so question number 12. Should the audit committee or the whole board be legally liable for the weaknesses noted in the review? Why and why not? Looking at the case, both the audit committee and the whole board of directors may be held liable for neglecting their duties. The audit committee is responsible for determining the management that will implement the necessary policies to ensure the company's internal controls are functioning properly and the company's financial condition is stable. However, it is because of the fact that they failed to comply with the US GAAP that they may be held liable. That being said, the board of directors, having much authority, is responsible for the delegation of tasks, especially to the audit committee regarding financial matters. So when the company failed to do so, as they were too busy manipulating the company's earnings and information, they also failed to oversee the work of the audit committee, and as such, they are already held liable. Next, please.
Question number 13. In February 2005, Nortel hired a new Chief Ethics and Compliance Officer using an incentive compensation scheme based on profits. Is this a sound arrangement? Since an incentive compensation program speaks on rewarding employees based on the level of performance one has achieved, Susan E. Shepard's appointment is not the best manner to demonstrate her objectives and capability to comply with the company's goal. Based on the scheme done, it is possible that the Chief Ethics and Compliance Officer won't have a direct impact on the entity's profit. So Nortel elected Susan as part of its strategic plan to improve its corporate practices and ethical conduct. Although she was reported to have been able to communicate with its employees these and the importance of secondary statement process and reliable and transparent financial reporting, it was not a sound judgment to hire her based on an incentive compensation plan, especially when during that time ethical values was an issue. It probably won't show Susan's objectivity and independence. Next question, please. Nortel has issued a new code of conduct with striking similarity to their previous version. Why might this new code be more effective than the last? With the fraudulent activities that took place, both employees and the management would prefer having a new code of conduct. The implementation will enable more rules that prevent such events to occur, which then causes better and effective planning and action by the persons involved. A code of conduct contains any rules and guidelines, which ensures that appropriate values are being followed in an entity. For it to be effective, it must be reinforced by a comprehensive ethical culture. While in the case of Nortel, reports were released that ethics was being de-emphasized. With the issuance of the new code of conduct, the employees will be motivated by the sudden changes and improvements that are raised and given focused on, and the management will not have any problem to force them to comply. Last question. Question number 15. In retrospect, what were the major failings of the Nortel Audit Committee? Were they the same as those for the board as a whole? So the failings are to identify significant excess provisions on the balance sheet, to identify the inaccuracy of the financial statements, to identify improper provisioning activity, to see the release of excess corporate provisions, to see the loss of the operations of the business units, and to oversee the compliance with generally accepted accounting principles or GAAP, and to ensure the financial integrity of financial reporting. All throughout the case, the board of directors and the audit committee were always mentioned together. Even though both recommended an independent review of the facts and circumstances, they failed to gain a full understanding of the events and failed to have direct management to address personal controls, compliance, and discipline. The BOD as well hid the fact that Nortel was already losing money and was only hiding it through the bonus plans that were not working well. Basically, the weak and ineffective internal control and lack of transparency led to many failures. Next slide.
So now the personalities mentioned. So we have here the former Nortel Chief Executive Officer Frank Dune, former Chief Financial Officer Douglas Betty, and former Controller Michael Gallagher. The Ontario Superior Court dismissed all charges against former Chief Executive Frank Dune, former Chief Financial Officer Douglas Betty, and former Corporate Controller Michael Gallagher of falsifying financial information in the early 2000s to inflate profits and gain bonuses. The scandal rocked the telecommunications giant, which at one time was one of Canada's largest employers. Each former executive faced 2 counts of fraud after being accused of participating in an accounting scheme which triggered the $12 million in bonuses and stocks for themselves. According to US News and World Report, they were fired in 2004 and pleaded not guilty when the case went to trial last year. The Ontario Superior Court Justice Frank Marocco said he was not satisfied in the financials were misrepresented according to US News. In the statement, Dunn said Nortel was always playing by the rules. And now, Nortel stock has been delisted and is worthless. But Nortel grew too quickly, overpaying for acquisitions with this inflated stock. The company was bleeding revenue as the dot-com bubble burst and spending on network gear vanished. Next, please.
Okay, so now what is the current status of Nortel's case? In the year 2009, Nortel announced it would cease operations and sell all of its business units. An agreement called an Interim Funding and Settlement Agreement, or IFSA, was signed by 38 Nortel debtor entities in Canada, the US, and EMEA, or Europe, the Middle East, and Africa. This provided for certain funding for the Canadian debtors by the US debtors, and also provided that the Nortel assets would be sold and the proceeds would be put into escrow. The parties agreed to negotiate in good faith and attempt to reach agreement on a timely basis on a protocol for resolving disputes concerning the allocation of the sale proceeds. However, the parties could not agree on an allocation process and the issue went to both courts.
It was later decided that a modified pro rata allocation is to be used as the decisions recognize the rights of each debtor estate to its cash on hand settlements and intercompany claims. So the allocation were as follows. For Canada, it received $4.1 billion, and for Europe, Middle East, and Africa, it received $1.3 billion. However, the funds from the sale of the assets did not belong to any one estate, and it could not be said that they constituted separate assets of two or more estates that would be combined. Thus, there was no substantive consolidation. So that will be all for our report. Thank you very much for listening.